Okay, so this time it's the net realisable value, or the NRV, essentially the total realistic amount that we're going to get for the stock when we sell it. So the formula for working out the NRV is that it's equal to the estimated selling price minus any direct selling expenses per unit. So what we're going to sell each unit of stock for, take away what it's going to cost us to sell those units of stock. So there's no point valuing stock at an amount above its worth because no one will ever pay that for it. So that's why, in line with our conservatism principle, we need to record the stock at its realistic value. So this could be because the stock is damaged, it's old or outdated or obsolete. There's some reason that we're not going to get what we paid for it. Or it could be out of season. When we talked about the ski jackets in class, and it got to the start of summer, they were going to have trouble selling it. Okay, so an example here. In 2001, we purchased the original iPods for $400 each, excluding GST. 16 years later, in 2017, we found a box of 10 of these iPods, and we need to get rid of them. As this technology is now outdated, it's been replaced by the iPhone, the iPod Touch, etc., we cannot sell them for the original selling price of $600. So our original selling price was $600, our original cost price was $400. Realistically, we can only sell each one for $100 each. So, following our NRV calculation is our estimated selling price, take away direct selling expenses per unit. In this case, we don't have any direct selling expenses per unit. So our NRV is simply going to be $100. Because 100 take away 0 is 100. So now we can see that our NRV of $100 is lower than the cost price of $400. This means we need a stock write-down. So a stock write-down is creating an expense to decrease the value of the asset of stock control and also to decrease owner's equity, to account for the net realisable value falling below the cost price. So again, with our conservatism principle. So the stock write-down is actually the difference between the historical cost price and the NRV. So in this case, we're going to go $400 being the historical cost, take away the $100 NRV, so what we're realistically going to get for it when we've taken away any kinds of selling expenses, gives us a $300 stock write-down per unit. Now the important part is to remember that there were 10 units highlighted here. So we need to say $300 times those 10 units gives us $3,000 as our total stock write-down. You can see in the general ledger here how we record it. It's quite an easy one. There's only 2 entries. Create the expense of stock write-down with a debit for that total amount of $3,000, 10 units times $300 each, and then we credit our stock control to decrease that asset by the same amount. Remember, our debits must equal our credits. The narration, again, is fairly simple. We're just explaining what's happening. 10 iPods written down, obsolete technology, memo 21. So the memo is the verifiable evidence, the source document, to explain why the stock write-down is happening. So the issue that comes up with lower of cost and NRV is when we think about our historical cost principle. Historical cost principle says that we need to value the stock at its historical cost because that is verifiable by a source document. With the NRV, we're dealing with an estimated selling price. So an estimation goes against our historical cost, against our reliability. However, it lives up to our relevance. It's more relevant to record it at a more realistic price than it is to stick with that historical cost.